Hi everyone, this is the ACap ReCap. I'm Matt Crisafulli. This is Ara Matt. We are partners at ACap Advisors Accountants. And today we're going to go beyond the blog and discuss whether or not buying individual stocks or buying funds are better investments. So Ara, what's better? Investing in individual stocks or buying funds?
So thanks, Matt. I'm going to go with the easy answer and say it depends. However, I'm going to explain why I mean by it depends. So with anything, we always say it's good to have a diversified portfolio. That's number one. And let's first define what an individual stock is, what we mean by that, and what we mean by funds. An individual stock is when you buy a stock directly with a company, or directly of a company, not with. So in this case, let's assume Apple. You buy Apple stock. That would be an individual stock that you own. Versus a fund would be buying an S&P 500 fund, and that fund itself would own all of the S&P 500. So you'd have, with just that one investment, access to 500 stocks within that fund. Again, the key is diversification. With individual stocks, it's very, very difficult to create a diversified portfolio because you'll have to buy so many different stocks in different industries, in different sectors, in different countries to have that diversified portfolio. So that's one part of it. The other part of it is that individual stocks by themselves represent a lot of risk. So it's true that if you buy an individual stock such as Apple, you have the potential to make a lot of money because it will go up really fast. But there's also that potential of something unknown negative happens with Apple or any company, and all of a sudden it loses all of its value. So you have a lot of risk with just that one particular stock. The other part is that if you're creating this large pool of individual stocks that you own, you really have to do a lot of due diligence on those companies, and that could be very, very labor intensive. So, but that doesn't mean that you should not have individual stocks in your portfolio. We're always a big advocate of having some individual stocks, but not having it be really overly concentrated in your portfolio. As an alternate, not so much an alternate, as a complement to having individual stocks in your portfolio, the bulk of your portfolio should be comprised of funds. And a fund, as I said earlier, is, for example, having an exposure to an S&P 500. But that's just one sliver of the market. You want to have exposure to international, to small caps, to large caps, to bonds, to emerging markets, to real estate. So all those different exposures to asset classes you can easily get with a fund, and then you can complement that with the individual stock allocation that you can choose for whatever stocks you want to buy, but to really kind of keep that risk low.
Right, and one of the things that comes up all the time when we're talking to people who are getting started with investing or maybe have a lower risk tolerance is they'll say, I don't want my money to disappear, to go away. I don't want my investment to go down to zero. And the probability of that happening with an index fund is next to nothing. The S&P 500 or the Dow Jones or whatever index you're tracking, the odds of that going down to zero are nil. On the other hand, tides change with companies. Right now, Apple's hot, but many, many years ago, Sears was hot. And really, so many companies, countless companies that you invest in and did great and had a great run-up, but times change, other players come into the market, and now that investment in that one company can go down to nothing, and that company can go bankrupt or change and go away, and then your investment will go down to potentially worthless.
Right. So remember, investing is a long-term endeavor, and when you're buying these investments, recognize that you're going to hold on to them for many, many years.
Right.
If your intent is to trade them quickly and get in and out of them, that's really not investing. That's speculating.
Yeah.
So what we're really talking about is holding these investments for a long period of time to provide you with retirement income and hopefully to be able to leave to your heirs and have them enjoy the benefits of these long-term investments. And that doesn't, as Matt mentioned, that doesn't necessarily happen as easily with individual stocks because one company that's great today could be completely obsolete 20 years from now.
Right. Thank you for joining us. This has been the ACap ReCap. If you're interested in learning more about our services, schedule a free consultation on our website, or you can call us at the office. We're happy to go over our services with you and see how we could be a mutually beneficial relationship.